Hey everyone, today is Wednesday, February 19th, 2025. This is our first video of the year. We last spoke to you 2 months ago on December 13th. We were a couple of weeks from the year end, and the market has pretty much played out the way we thought it was going to, or we talked about in that video. I'm going to cover three things today. We're going to talk about where we are since our last video. A lot has happened, and there's a lot going on between the end of December and month and a half into the new year. I do want to spend a few minutes also, number two, talking about what it's going to be like investing during the Trump presidency, Trump 2.0. We've kind of been here before. The lessons we learned in the first term were very tough to navigate, and it's playing out exactly the same. So we're going to talk a little bit about what investors can expect and how to use the market to your advantage during some volatility that may cause. And then finally, we'll wrap up with our early look at 2025 and how we're positioning and what we see happening. So let's just jump right into it. So since the last video, markets did play out as we expected. We talked about we were going to rebalance our portfolios in the first week of the year. We did that. We expected a lot of other people to do the same thing because the market has gained 60% pretty much, like %, in the last 2 years. 2023 and 2024, both well above 20% per year gains. Our portfolios have exploded higher, and we've been in the right sectors, heavily weighted toward tech, artificial intelligence, the Mag 7, and we think those themes are still intact. And but they're also going to continue to be very volatile. We also talked about we may get that correct. We expected a correction in the first 2 weeks of January when we rebalanced. We rebalanced on the 3rd through the 5th of the month, not waiting because we thought everyone would do it and push the market lower. We then said we might get that correction in late December because the big money, the hedge funds that have different tax advantages, they're going to front run that rebalance and that selling, that profit taking in the new year. We take it in the new year because we want to push the capital gains tax payments we'll have to make on our gains out to April of 2026. Hedge funds don't care. Some of the managers have carried interest. They want to book the profit in that year so they get paid for it. Their incentive comp. So that happens quite a bit. So that played out. And why I like us knowing that how it was going to play out is that means we're really in touch with the cross currents, the underlying trends in the market, and it just means we're dialed in. So now, since the first week or two, for 2025, January and this first part of February, first 3 weeks of February, we have gotten this very choppy, slightly upward bias, sharp rally up, hard correction down. December 18th, had a very sharp, like a 3.5% correction. That's really big in the market. I think the Dow was down as much as 1,000 points at one point in the afternoon. We have been in a hold since January 23rd. That's a month ago almost. And what we've seen since then is you're getting this violent up, down, but the market is basically going sideways with a slight upward bias. Markets are up strong. They're up like S&P 500 is up 4.5%. I think the NASDAQ 100 is up 5.5%. So that's actually a really good start. But if you looked at it on a chart, it's kind of just all this volatility going straight across. What we call that is we call that backing and filling. What's going on is the market was up so much in the last 2 years that the stocks are fully valued, and you got violent swings because there's so much profit in it. The slightest bit of bad news, and people are going to take some profits. And again, we just use that to our advantage. So we did do one shift to our strategy in the new rebalance. We actually are out of international pretty much. Odds are high that stuff's so cheap it could go up. So maybe in the short run, Europe goes up and Asia goes up. We can get back in it really quickly. I still think technology in the U.S. And some other sectors are going to lead the market, and I don't think we're going to see much to the new year. But in our core strategy, we usually run an endowment strategy. It's large cap, mid cap, small cap, international, developed markets, emerging markets, and in fixed income, same thing, all over the place. Treasuries, high yield, corporate bonds. So we run it like an endowment. And what we're doing now is we've decided most of our success the last decade has been in our core portfolio of individual stocks. So we have taken 10% of our equity sleeve and added it to our top 20 favorite stocks. So investors with us will see that in the portfolio when they get their month-end statements. We're going to talk a little bit here about, let's switch gears over to the Trump presidency and what investors should expect. So as you know from the first regime, and first I'll start out by saying, this is not political at all. This is not a for or against Republican Party, the current administration. Zero to do with that. You know how we play. We never get into politics here. We don't have the luxury of that. We simply just see which parties are in charge, what their views are, and what policies that are in place, And then we adjust our portfolios to best position for those policies in terms of how we're going to make money that year or preserve capital. So we don't really care what party's in charge. We're going to figure it out. So if you remember, though, what you can expect as an investor with Trump is on a daily basis. A daily basis, he's going to make news. He enjoys it, right? And he does it in a shock and awe event. And it can cause amazing dislocation in stock prices in the short term because he just does a tweet, a 3-line tweet can rock a company 10 or 15%. He did it just after the election, I believe it was. He said that Taiwan Semiconductor stole our information, and we're gonna have to address that. And Taiwan Semiconductor went down 16.5% in a matter of weeks in late November. It went from like 205 down to 180 in price, and now and then what happens is after the shock is off, it kind of the statement doesn't have any follow through. I mean, it might in a couple of years, but it doesn't have any follow through. And now the stock is kind of grinded back up over 200, hit 220 a week ago. So from 205 down to 180 up to 220. So what you have to do is you have to understand that he enjoys rattling markets and rattling the media, likes the attention. Whether it's good for the policies long term, whether it's not, that's not what we care about. As an investor in this administration for the next few years, we have to not overreact to statements. Take them just with a grain of salt and think in terms of its media shock and awe. And then if we like the stock, we're going to buy that pullback if it causes a disruption on the downside. Because what's going to happen is the news is going to die. And then we do believe you can buy our core portfolio of stocks because they're so fundamentally strong. They're so sound. They're the best, biggest, fastest growing companies in the world for products you need and use every day. We can lean into them under pressure. So we are going, remember what we say about the stock market. When you own stocks, you're not trading paper, you are buying percentage of a business earnings. That belongs to the shareholders, us. And the market is simply there to serve you. So, right, the volatility of the market has nothing to do with the value of the company. So we are going to let the market serve us as we get all of these radical statements and these policies rolling out. And we expect there'll be some doozies. So that's how we're going to play it there. Let's move on to our outlook for 2025 pretty briefly. So I'm going to start off that 2025 we think has an upward bias. I'll just put it that way. We usually make predictions like year-end forecasts, et cetera, like that. It's too early in the year. There's too much going on. There's too much policy changes going on in Washington. So we don't quite know which way the wind is blowing. But we feel it's a great market setup. We've said this before, even if we get a correction in the first half of the year. I love the market setup for long-term investors. We've got cash at over, you can make over 4.5%, 4% in various money market funds or short-term T-bills. Bonds are yielding between 5%, 6% without even going to junk. You can get 7% if you move into some of the higher yielding bonds. And then, of course, we've got equities that are on a tear with this massive infrastructure build out of this next generation of technology. It is far from over. It is as big as when they came up with the internet, when I was first getting in the industry in the late 90s. I do think it will end in a massive overinflated bubble that will one day bring a collapse of that bubble. But this is a 20-year run. I think if the market peaked in January of 2000 before the bottom in 03, when the tech bubble popped, I think we're in like 97. So we probably have we're in 97, 98, 99. And then we do expect it to get pretty frothy. That being said, the market is right now trading at 22 times the next 12 months earnings. That's on the high side. That means that, for $1 of share, it's trading, the price of the market is 22 times higher. Cheap is anything under like 18. Expensive is anything over 21, 20. But just given what's going on with the massive growth in the tech sector and the high demand to rebuild all of your infrastructure, technology infrastructure, it's justified. But it's full. It's fully valued. Number one. Number two, the market is currently overbought. Okay, even when we've been doing this choppy sideways act, it's overbought. And more importantly, because of this choppy action with no directional change, certain technical indicators we look have the market coiled like a spring for a violent reaction. We never know if the market's going to violently break when it does this up or when it's going to break down. But if I had to make a guess, just given what's going on, it looks like it wants to break down. Okay, and I do think that if we're positively biased on the market for 2025, I think the first half is going to be more of what we've seen. This we call backing and filling, digesting the 60% gains of the 2 years. What's going on now at the valuations of the market, you've got corporate earnings. Companies actually have to generate the earnings the market is forecasting. So the market price is up where we think you're going to earn, and the companies are down here. They actually have to go and earn the money. And when it does, you'll begin to see the market then get a clear advance. And I do believe that's going to be a second half of the year event. And it could get quite exciting second half of next year into the end of this year in 2026, just because every company is going to have to spend billions. I mean, what's going on with this artificial intelligence? It starts at the producers, the tech companies like NVIDIA, highly positioned a few years ago, made a ton of money off of that. They create the product. And then you got companies like Palantir. We bought into that several years ago. Palantir is now the hot stock of the year. We bought it last November for some accounts, up 400%. Palantir delivers that processing power to corporations and governments. Eventually, it's going to go all the way to companies that deliver it to you and me. It could be Apple, it could be Microsoft, but there's going to be a company we don't quite know yet that is going to be bringing all of this horsepower and technology down to the end user, everyday people, in a device like the Apple iPhone that sits in your pocket. So, yeah, so that's where we are on this market. Right now, we're in a hold. The market is coiled tight. We do expect it to break soon. I would, if I had to be a betting man, I'd say do it today. I might dabble in some puts in my personal account. And if we get that weakness, we're gonna be buying into it. We're sitting on a lot of client cash that's come in. We really get a lot of money in the end of the year, first quarter bonuses, etc. And that's really it. If we'll try to get out more videos more often. I try to do at least 2 a month. We didn't do one for 2 months just because it was so busy around here. David and I leave for our annual Florida trip, so we're going to be all parts of the state next week. So we'll be back at it. I think we'll get back next Friday. So yeah, anyway, it's been a good start to the year. We'll talk to you all soon, and let us know if you have any questions. Bye.